Today, we have a market with a GSG index rising to levels we haven't seen since 2022. We have PCE coming in above the target of 3.0% of core, leaving so much less room for the Fed to cut rates with we desperately need. We have bond yields rising to price in the inflation coming. We have NVDA out here saying that they're going to do $1 trillion worth of revenue from chips by the end of 2027. And we have all the market psychology indicators in disarray with the fear and greed at 23. We have an extremely high put to call ratio still rising even on a green day with the markets up 1%. Let's get into this video. We have so much to cover and show you our take on the markets and everything happening because there's so many different factors that are going on right now. First off, let's take you right into this GSG index. For people who don't know, a GSG index is part of the market basket, the CPI, which is the inflation report. The PCE is what the Fed most uses because it's the service-based economy, and that measures more of the services. But the CPI is another great indicator for inflation. As you can see here, what's happening in Iran, if you know, is there's a war, and a lot of the world's oil is produced there. So whenever oil and gas prices go up, that leads to inflation going up, which alleviates a lot of room for the Fed to cut rates. Just think back to 2022. How much were your gas prices? $4 plus, maybe $5 in some places. And what did that do? We had rampant inflation up to 6% at that time. That would be horrible to happen in a time where we have a GDP report coming out half what it was supposed to be. It was supposed to be 1.4% estimated, which already was down revised to only 0.7% in the fourth quarter, a labor market deteriorating with unemployment going up, and a whole market in disarray with this war happening in Iran. There are so much events happening in the market right now, and you need to learn how to manage your time in the markets and what you should be doing and what the most probabilistic outcomes are right now. We're going to take you through all those today. So let's go here and look through this GSG. Obviously, you can see this huge climb from about 20 to all the way up to 30 right now, a 33% increase led by the oil prices flying rampant to over $100. Right here, let's go back all the way till 2022, and let's go and take a look at what were these prices at that point, what were they, and what happens whenever GSG rises, what really precedes it. Well, with what we see here, look what happens last time GSG completely rises, end of 2021. And if we're going to bring up the market here and just show you the correlation, that is such a dangerous indicator to see because whenever you see GSG rising, if you think back to what happened early 2022 and 2021, they had to raise rates because inflation went rampant to about 6%. Whenever inflation goes up, there's no rate cuts, and rate cuts help stimulate loaning and consumer spending eventually, leading to higher revenues for companies, and you're not going to have a recession happening. So this is what happened here with the GSG. You can see it goes up, 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 and what's the market doing? All the way from down, down, down the start of 2022, up all the way till October-ish of that year, and then the market starts to rebound as, look what happens, the GSG index starts coming down with inflation coming down, leading to the market finally finding a bottom. Historically, the market really will proceed 6 months in advance of inflation going down because it's always forward-looking. That's why whenever we're looking at the market, you want to be using forward pegs, forward Ps, instead of the trailing 12-month because you don't want to be looking at indicators back in the time. A great indicator, though, to look at to see really where is inflation is what's the 10-year pricing. If you see the 10-year going up whenever you see a higher PCE, that means it's starting to price in that inflation is going to be going up in the future, and people are starting to demand more and more returns, yields on their bonds to lock up their money for however long. This is super, super important because you really want to look at bonds and what those spreads are. And let me just show you something else here, the high yield bond spreads, okay? So this is here high yields. If they start breaking, this is pretty preceding to anything happening in the market. Whenever you see them just start flying up those yields, just even here, look at right here, look what happened in 2022, start of 2022, they fly up these yields because those are the things that are they're called junk bonds. They're what people will get the most yield return, but you also do for a company defaulting and not being able to pay out that money to you. So right now, if we just take a look here at the 1 year and see that they're actually starting to come up right now, but it's nothing too crazy happening right now. So if there are anything, they're holding in check for right now. So that's a pretty good sign to see in this economy because if these spreads start going crazy while equities stay around that same level, this chopping that we've had for the last 6 months, if you just go back to this chart right here, you can see that equities have basically just been staying right here around this level for the last 6 months, and the spreads haven't broken or anything yet, so that's a great sign to see that the bonds aren't preceding anything happening in the market. So that's just something to keep a lookout on, because 10-year is obviously going to reflect the inflation. Another thing that we want to talk about, like I said, the PCE came in at 3.1%. The Fed wants a 2% is their target rate. So whenever it's higher than 3%, it's hard for them to cut rates because it's not at their target rate on their projections and their modeling. And this FOMC meeting is happening this week, so it's going to be interesting to see if they're dovish or hawkish. But like I was saying, a delayed rate cut is higher borrowing costs for the consumer, and many Americans have problems paying these bills, so that's why you're seeing some stocks that are consumer discretionary, maybe like a Celsius or something that we're huge on, have problems right now, because if you have higher inflation and you don't have rate cuts, people don't have as much money to end up spending back on those stocks. Instead, they're forced to pay the bills that they have today, and that all that money is going towards there because those bills are higher than they really would have been with rate cuts and lower inflation. And then this war even makes it worse with you have GDP in problems. Then the war with the GSG rising, you see what happens, inflation goes up. That could be stagflation, which we haven't seen since the 1980s. Stagflation is whenever employment's going up, GDP is going down, and inflation is all going up at the same time. And that's the worst possible scenario, because the Fed can only do one of two things. They can either cut rates or lower rates, and with that, quantitative easing or quantitative tightening. Quantitative easing is whenever they're buying back treasuries and they're making the prices of the treasuries go up and the yields go down, so people look to put their money more into equities and instead of savings accounts into the market, because they're not getting as high of returns, which is very, very bullish. And that's what you see in expansion times and bull market cycles. So that's another problem to think about, that the Fed can't cut, but they can't hike. They can't do anything right now. They're almost stuck. And that's a huge, huge problem, because Trump and them, they need the rate cuts. Wall Street was pricing in 2 rate cuts this year, and now they're maybe not even pricing 1 anymore. So it's going to be interesting to see with the new Fed chair coming in later this year what's going to happen. But mainly, if this war keeps going on for a while, oil keeps going up, just like we showed you, it's in the CPI and the GSG going up. That's so dangerous, because you could have stagflation, in which we even saw some stuff happening a little bit ago whenever yields went down off of a high business report. PMI came in good and inflation came in high, that people were starting to go stagflation, flight to treasuries, where they're just going to take the yields they're given because they have no idea what's going to happen in the economy, getting ready for a recession. But there are some good things happening right now in the market, is these fear and greed indicators, and the put to call ratio is where you see a 23 extreme fear. It's actually good, because every time you see this in extreme fear, if you think of the lows, in April, look at the market's bounced up. And if you think November, it got down here to 6, the market's bounced up right there. So that's kind of good, that you want to see that people are very worried about the market and they're hedged up, because there's less and less people to pull to the downside eventually after that happens. So that's just, you kind of think about it. If you hear everyone on Twitter, everyone on the news saying, oh my God, recession, recession. If you see the VIX spiking, the put to call ratio up, like we've been saying, those are always great times to buy DCA. You may not be able to catch the bottom, because it's obviously hard sometimes, because you can't just say, oh, this is the exact bottom of the market right now. You always just want to be buying whenever you see these indicators, like the VIX going up above 30 is a great time to buy, getting close to 30, great time to buy, or even any deals in the market you see, like we're about to show you with NVDA and their revenues and what they're being priced at right now on PE-wise. Those are great times to buy whenever the macro half lines up, or the macro super lined up. But at the end of the day, if you're getting a steal deal of the company, you buy that stock and you want to DCA in, or just go all in at once, whatever you want. But what we recommend is DCing in whenever you see it down, you take some in, leave some reserves, and then until you get the VIX above 50, or it's at an absurd price that you're getting so much return that's like, I can't miss out on this, is really what you do. But whenever, like we've been talking, whenever you see the market getting higher valuations, you want to keep higher cash, and you always just want to keep those cash reserves up with more income than expenses, so you can keep adding to the money that you have to invest. So that's just something huge to do. And even as we look through, look at everything's in extreme fear. Everything's in extreme fear. People are selling it. The put to call options, like we were saying, is above 0.847, almost 0.85. the market momentum, everything extreme fear, those are almost always the best times to buy in the market because you don't want to be in the crowded trade. Think of it. Every time everyone's like, oh, we're in a great bull market at the top is whenever people are the most euphoric. You can just think back to silver. It got up to 120. And now, let's just pull this silver chart right here. Let me just go and take this off. Silver. I think it's silver. But basically, this is right. Yep. Look at this. Look at this chart right here. Extreme. Look at this euphoria run. It happened here. And then look at this silver just going straight up at the very top. Even something we saw in the NASDAQ and before that straight dot-com bubble. Look at whenever you see a euphoric run at the top, that's whenever you want to get out. Whenever you see everyone on one side on a trade, not looking to the risk, everyone taking bets on margin, that's whenever this happens in the thing. So just think of the reverse. Instead of it's going down, everyone's bearish, and then you're going to have a fly to the up just like you had in April in the market. So you just want to think of that. You don't want to be in the crowded trade with the group, because if you're in the crowded trade, everyone's all in, and there's nobody else to get in more into the market at that point. And just even look at the put to call ratio. Every time it spikes, like we showed in a different video, over 1. Let's just go back and look to what it was in August, okay? It got all the way down, April of last year, it got all the way up to 1.250, and then what happened? The market V recovery. So anytime you see these indicators that people are super, super bearish, look at even the VIX right now. Let's go to it and show you. Every time you see people super extremely bearish in the market is usually pretty unbelievable times to buy because no one is buying, everyone's selling, and you want to be doing the opposite. Just like Warren Buffett said, be fearful whenever others are greedy, like the silver, the euphoric top, and greedy whenever everyone else is fearful about stuff happening. Look at the VIX. We got it over a 50 here. Over a 50 piece, and then you saw what happened. You got so great return. Stocks were doubling up or tripling up coming out of this because they've been halved for no reason whenever nothing policy actually even went into place just on speculation. So now we're just going to go through you. Jensen Huang, like I said, they said 1 trillion revenue by 2027. That marks up huge steps, and just you got to revise your projections and know the company with their new chips coming out and saying that they are the best. And the CEOs, you got to kind of know your CEO. Like we said, is there a sandbagger, or are they someone who's going to say, hey, like, bump on their prices and then maybe not perform? So basically, he was at some investor summit today and came out and said that. So 1 trillion revenue for over the next 3 years. Say they did 215 billion in 2025, so last year. Now this year, we have them doing revenue growth in line with their projections of 55%. The next year after, they're actually going to decelerate at a lot less than people thought. And they're saying at least 1 trillion. So we have them doing 500 billion revenue in 2027, which is their fiscal year 2028, but our 2027. And if they do this, expand margins like they've been, we have a very reasonable, not even crazy expansion, only to 63%. They will have an EPS of 13.04. Pair that with a P of 45 to 40, a 554 stock midpoint price, which is a 200% gain from now in 2 years of a stock that's so undervalued, and in a sector that has $650 billion of capex being spent on it just this year, with them getting the majority of that, and we're only projecting them for 334 billion revenue. And mind you, they beat numbers like it's nothing. They've been doing it. That's what they did. They just come in. What did they do whenever they went up thousands of percents? They just came in and would just blow Wall Street out of the mind. And you should expect a company that is able to do this, the leader of an innovation, and that's able to do that. This is such like companies that can do that, and this is so bullish for companies that we've talked about, like an AMD, which all they need to do is just get 10% of that market share, and they're doing $100 billion revenue next year whenever they were barely doing over 30-something this year, and they could have a P ratio of 50 to 60 times 12, and that gives you a 3x of AMD over the next 2 years, which is even more than NVIDIA. So just thinking about that, you got to think if it affects one player in the sector that has going to need to have more players, it's going to affect other companies. Something like an AMD is the other second upcoming player. So that's what you think. Like you see Nebis getting a deal. What's that? That's bullish for Iron eventually because we like that stock, and we like it because if Nebis is getting deals, they're going to be supplying power, and they don't have as much power like crazy to go into everyone. So other players are going to have to get big deals in there. So you can kind of think if a sector is doing good, that's a sector you want to be in. And if you can apply those trends in your mind and know what's going to come, or even if you're a little bit late, but you find a stock that hasn't had a deal, that has to have a deal almost to, it has good products, that's where you can really make your money in this game. So just touching through that, there's so much going on in this market, and make sure to stay watching us and learn more about whatever's going to be happening. We're going to explain it for you guys and give us our points of view, and maybe you guys have points of view, so leave in the comments if you have any questions or any takes on us, because we're always around here trying to learn and everything. And we're trying to just bring the best platform ever and to learn together. So just subscribe and leave a like, please, on this if you want to see more.